Hi guys, good afternoon and welcome to MF Corner. I'm Pavitra Parekh. With me is Sonal Putra, and today we are joined by Harshvardhan Roongta in the studio as well. So first of all, thank you very much for making the trip and for coming down to the studios. You know, it's always much better when we have our guests in person. So
Absolutely.
Thank you for making the trip. And today we have you here for a very interesting topic, right? One that we've not discussed also before. We're going to get you an in-depth look at arbitrage funds today. Now, arbitrage is basically simultaneously buying and selling the same underlying securities or its derivatives in different market segments to make risk-free profits, right? So consider this: if the price of the same object is different in different markets, you can make a risk-free profit by buying the object in a market where the price is lower and then simultaneously selling it in the market where the price is higher. But from a mutual fund investor perspective, there are a lot of questions. Who is this best suited to? How expensive are these? Because, you know, you are carrying out trades very frequently. And then what is the kind of time horizon as well that you should have? So a lot of questions to get through from an investor standpoint.
Oh yes, also because it's not an easy trade to do, right? Yeah. It requires an expertise as well. So we have the expert with us. Harshvardhan, thank you for joining us. And, you know, we were looking at the fund flows as well, especially in this category. After continuous decline that we saw over last couple of months, in February there was a little bit of inflows. So was in April as well, after that big dip that we saw in the month of March. What are the flows suggesting now after the big tax changes that we saw? Do you think more interest is coming in this category?
Absolutely, Sonal. So, I mean, you know, talking about arbitrage funds, and if you just look at the entire construct of the whole thing, you know, you saw the AMFI data of April 2023. Now, they suggested, I mean, if you look at, you know, there are about 26 AMCs managing, you know, close to about 81,000 crores in arbitrage funds by itself. And if you look at the tax changes that took place and effective from 1st April 23, where debt funds are going to be taxed as short-term capital gains, I mean, irrespective of the holding period. So we see a lot of funds coming into arbitrage funds now, of course, naturally, because of a simple fact that is more tax efficient when you compare it to a debt fund. I mean, a liquid or an ultra short, a low duration or money market funds. Arbitrage funds are very, very tax efficient in that sense. So we saw about what, 3,700 crores come into the arbitrage funds only in the month of April 23. Now, you know, in all practical aspects, you know, the arbitrage funds do not hold any pure equity exposure. So as you introduce the fund to say that you're buying and selling at the same time, just trying to capture the difference in the prices of the two markets, and you book your profits in that sense, you lock your profits rather. So they are not having any pure equity exposure, and they enjoy an equity taxation. So so most certainly all those investors looking to invest into, for say probably a tax efficient and they are into say probably a 20 to 30% tax bracket would find this you know, segment very, very interesting.
Okay, that makes a lot of sense, and no wonder interest is picking up in this space as well. But Harshvardhan, tell us, who should really be investing in this? I know you spoke about the tax part, we'll get to that, but you know, I'm talking about more from an investment horizon kind of perspective. How long do you need to be invested in this category? Because you can look at it from quite a short horizon as well, right?
Yeah, absolutely right. In fact, so let's just take one step back and understand in a little bit more elaborate way as to how an arbitrage fund functions. Okay, so as you introduced to say that, you know, you're taking the advantage. So probably what this fund will do, they will invest into the cash market. So they'll buy one particular stock of a company in the cash market at say 100 rupees, for example. And in the futures market at the same time, if it's trading at say 102 or 103 rupees, they will sell the same quantity of the same company right now itself. So they lock in that difference, and the holding period will be approximately say 30 days, for example. So the profits are booked, you're locked in that profit, there is no exposure that you have any further into pure equities, and at the end of the term you pocket the difference, and that's your gains. Now those gains essentially are cost of carry. Basically, you know, holding on to a trade for 1 month, and whatever your risk-free rate of interest would be at that point in time is the kind of return you should expect from an arbitrage fund, which would be approximately 7% plus minus right now. Now, who should look at this? I mean, of course, anybody who's in the 20 to 30% tax bracket, I mean, most certainly makes sense for them, because the taxation of arbitrage funds. Probably we'll discuss that later into the show. So you will have a tax advantage vis-a-vis a debt fund, and the holding period being a minimum of 30 days, because you know you have certain exit loads being levied by arbitrage funds if you exit within 30 days, and some funds have even 21 days and 15 days as well. So if your minimum holding period is about 30 days and you're looking at say up to a 1 year period without actually knowing when you need the money, but you can withdraw whenever you want. So I think this fits in very well for those kind of people.
Okay, so there are a couple of numbers that you mentioned. One of them was 6.5 to 7% returns. How does it work work versus say liquid funds, because here 30 days is what you're saying would be the minimum holding period be as well. And when we talk about who it is very efficient for, after tax returns, what kind of income level should a person look at arbitrage funds once they reach there?
Okay, so if you look at the past year returns for an arbitrage funds, they've generated about 6.5 to 7% return. Now this is pre-tax, okay, net of expenses, pre-tax return of 6.5 to 7. Now if you take a short-term capital gains applicability, because the taxation on arbitrage fund, as I mentioned, is as per equity categorization. So what equity taxation is, that if your holding period is less than 1 year, all the gains that you make is short-term capital gains, and 15% tax is levied on that. If your holding period is more than 1 year, then 10% tax, of which also first 1 lakh is exempt. So if the first 1 lakh that you make as long-term capital gains is going to be exempt. Now you compare that with a debt fund, a pure debt fund, and as per the income tax regulations, if the equity holding in that scheme is less than 35%, which is the case with liquid funds, your short-term funds, ultra short, low duration, money market, all this will have obviously not have 35% equity. So the taxation over there, holding period increases to 3 years. The short-term capital gains is as per the income slab of the investor. So if you are in a 30% tax bracket, you pay 30%. If you are in a 20%, you pay 20%. And long-term capital gains post 3 years of holding is 20% with indexation. So most certainly it's obviously going to be more heavy on the taxes when it comes to debt funds. Now look at a scenario that in both cases, in the liquid fund and the arbitrage fund, we're looking at a portfolio level YTM of about 6.5 to 7. So that's the kind of return, for the sake of understanding, we say that investor is expecting. In case of arbitrage funds, the taxation less than 1 year will be 15%. And in case of debt funds, it will be probably the tax slab, which is 20 or 30%. So post-tax returns on a 7%, if you take a say a 15%, so your net off is still going to be 6 something. Whereas in the case of a debt fund, a 30% taxation slab will fall straight to 5.5. So that's the clear difference why an investor would possibly try and look at investing into arbitrage funds when compared to debt funds.
No, I'm glad you made that very clear, because this is a topic that we get a lot of questions on how to pick between these categories which are compared so often. But also take us through some of the risks. So actually, I won't call it risks, but maybe just some things that you should keep in mind before you get into this space. Anything you would like to tell our audience?
Yeah. So in fact, when you invest in arbitrage fund, that's what we're talking about right now. So very clearly, there is no market risk. As I said, once you freeze into your transaction of buying into the cash and selling into derivatives,
you already know the price.
You know the difference. So the price movements don't have any impact on the profits thereon. So there is no market risk. There is no credit risk as well, because you're not investing into a paper with a AAA, AA or something like that, which ratings are likely to fall in the future. So then we're not looking at that point itself. There is no mark-to-market risk as well. In a debt fund, if the interest rates move, you'll see that reflecting immediately. In this case, you freeze onto both legs of the transaction. So there is no mark-to-market risk as well. So in that sense, there is no risk. However, you'll have to understand that in case the arbitrage opportunities reduce in the future. So we're already looking at lots of funds, lot of money into this arbitrage segment already. As I said, 81,000 was the average assets managed by the AMCs in the last month, in the month of April rather. And if you put this and you add the arbitrage section of the balance advantage funds, the dynamic asset allocation funds, they also allocate towards arbitrage, right? So if you allocate that, add it into the arbitrage, it's about 60,000 crores getting added. So that's 1.4 lakh crores being invested in arbitrage opportunities in the market. Now, as long as the market can absorb that kind of a volume, you'll find the spreads. And if the spreads keep contracting, your returns will come down. So that's the only thing you'll probably want to be careful going further.
So it's a volume game as well here, right? It's needed, volumes needed to earn that spread on arbitrage funds. In that case, let's talk about costs involved as well, because the trades happen every day. So how expensive can these funds get for an investor?
So the nature of the fund is that there's going to be high turnover. It's not just buy and hold for long, right? So there is going to be a transaction, post which we've anyway seen all the expenses that you put in together also. The returns have been 6.5 to 7. So I think post expense, you have to see whatever you're getting. And then that is in line with the liquid funds. So if that is the case, arbitrage funds definitely have more turnover as compared to debt funds. But at the end of it, if you're getting the same kind of returns, post-tax better returns in arbitrage, then of course, I mean, you would want to ignore all the costs that comes with it.
Yeah, no, that point is well taken. You were also mentioning an exit load earlier. You want to tell us how much is it? What is the kind of exit load that you have to pay?
Yes, so as I said, most of the schemes will have an exit load, and rightly so, because see, they're buying into cash, selling into futures, and that entire contract period is about, say, a month. And if you come in between and say, I want the money out, there is a cost that somebody has to pay. So that you would have to, as an investor, want to pay. So the funds, all of them more or less have a 30-day exit load period. If you redeem within 30 days, there is going to be an exit load. However, some funds have 15 days and 21 days as well. So you'll just figure out, but most of them are essentially 30 days. If you withdraw or redeem before 30 days, then there's a 0.25% exit load in general. Some may go up to 50 basis points, 100 basis points as well. That is what is important. I'm glad you brought this up, is because 0.25% is of the principal that you invested, not on the returns. So if you're generating 6.5 to 7, doesn't mean that 0.25 is taken out of that. So if you invested a lakh, then 0.25 is on lakh.
Oh, okay.
So that is a large cost. I mean, that's a huge cost if you're just investing for a
making sure that you're not going to get out before that period.
Exactly, and that's an important clarification. If somebody would have thought, okay, 6.5%, you know, we'll just take it off 0.25%
not
of
that much.
But it is much because it's on the principal. So that's an important clarification. And this has been such an interesting chat, but we have to slip into a short break, Harshvardhan. We'll do that and continue our discussion with Harshvardhan Roongta on arbitrage funds on the other side. Stay tuned. Welcome back. You're still tuned into Mutual Fund Corner, and we still have with us Harshvardhan Roongta of Roongta Securities, and we're talking all about arbitrage funds. What's the opportunity here? Who should be investing, and a lot more. When we have spoken about how these funds see heavy execution, that daily trades, the volume is really high. The role of the fund manager really becomes important. Do you think that is something which the investors should emphasize on and take care of very specifically in this case?
Yep. So Sonal, it is true that in any case of fund management, I mean, there is going to be a fund management expertise. So if you say that anybody, fund manager A, B, C would do the same thing in the same market, no, that's not true. Now, if you just simply compare, I said there are 26 funds schemes in the market. If you compare the top performing and the bottom, okay, there's a difference of 200 basis points. Now that's quite a bit. So 2 percentage point difference between the worst performing scheme and the best. You'd rather want to be with somebody who's at least average and above, like category average. Now the good part about this category is that of the 26, probably 4 or 5 would be in the bottom, below average, category average, and the rest are all close to the average or above. So your chances of getting a good fund management manager are good, high. So all you need to do is just make a list of schemes that you don't want to invest into, or rather should not be investing into, and then any other scheme on that category would probably get you a category average kind of a return. So yes, there is a merit, there is some kind of thought to be given to who's the fund manager, which is the fund house, etc. More or less, your likelihood of getting a good scheme is higher if you just know what not to invest into.
Okay, so that is on the fund manager aspect, but take us through everything else that you should, consider when you're getting into an arbitrage fund. Is it like a regular health check that you would do on any kind of fund before getting in? And also, if you have any recommendations from what is, like you said, we have only so many available, so are there some that you prefer?
Yeah, so Pavitra, your basic hygiene elements would remain the same as if you're picking a scheme for long term, right? Because you're starting off with saying that I want to invest for a minimum of 30 days and probably going further. We've seen some cases where investors have been put since about 2 years also. So you'd rather want to pick a scheme which you follow all the hygiene. You follow all the hygiene factors such as fund manager, of course, the costs that are involved in it. What is the expense ratio of the scheme? What is the consistency of performance in different market cycles? As I said, the arbitrage funds would do very well in volatile markets, and once the AUM starts growing, then the opportunity starts shrinking. So you need to keep an eye on all that bit. Now you'll also need to keep in mind what is the AUM of a particular scheme that you're investing into. So like the top scheme would have about 20,000 crores managing in just one scheme. Or going down, you'll have somebody with a few hundred crores as well. So you'll need to keep all of those things in mind. Now what I have done, as you have asked, is that you need some names. So I just picked probably top 5. Which you can keep in mind in regards to even the fund, pedigree of the fund house. So there should be a good fund house managing overall equity assets and debt assets. They should be doing well. So one would be Kotak Equity Arbitrage Fund. Now this is the largest scheme in the category. They have about 20,000 crores that they manage just in the scheme itself. Then you have an ICICI Pru Equity Arbitrage, ABSL Arbitrage Fund, SBI arbitrage and Tata arbitrage fund. I think these are the 5 that we could pick when you take all the parameters into consideration, and an investor need not actually spread the money into all of these 5. You just need to pick one. And in most likelihood, if you already have a folio with any of the fund houses of these 5 and you want to pick an arbitrage, I think just pick the arbitrage of the same fund house.
Okay, 5 of them would be good enough for our viewers to to take a glance at and figure out if they are good enough for them or not. You know, we have spoken about the taxation on arbitrage funds. We have spoken about the returns as well. Now let's do some comparison, because since this category is good for investors with shorter duration investments, so is liquid funds. Between the two, if we compare both of them, which one would you recommend? You know, considering that the time horizon is shorter and maybe the returns would differ in these cases.
Yeah, you know, so Sonal, what is important, as I said, is the tax bracket in which you fall into. So if an investor is into a 10% tax bracket, and you know, liquid funds and arbitrage funds are giving approximately the same kind of returns, and the range is also the same, 6.5 to 7%. The outlook for the next year also seems to be around the same. Now, in a liquid fund, you will, if your portfolio YTM is say 7%, you know, the minus your expenses, more or less is the kind of returns you will get. In arbitrage funds, you know, sometimes your returns could spike as well, because you know, suddenly the volatility may go up, or you may find some arbitrage opportunities wherein your returns possibility of going slightly higher is also there, at the same time going down is there. So one is your tax consideration. If you're in a 20 and a 30% tax bracket, then arbitrage funds make more sense, because the short-term capital gains are 15%. So post-tax returns are going to be higher. The next part is, of course, if your holding period is minimum 30 days. In a liquid fund, you don't need that as well. You could have a 7-8 day horizon and you can still invest your money there. In an arbitrage fund, you cannot do that, because as I said, there's a 0.25% exit load on the principal that you invest. So you don't want that cost to be on you. It wipes out all your returns. In fact, takes something more than that. So minimum 30 days, in liquid fund you don't even need that. Taxation is your base, I mean, what is your tax slab? And then of course, I mean, you look at the opportunities in the market. If you feel the arbitrage opportunities are going to be better going further, then it's one part. Otherwise, you stick to liquid funds. I mean, it just depends on all these 3-4 factors.
Okay, that is understood. So it depends on your, you know, tax bracket. That is how you can perhaps decide which one is better for you. You've taken us through some options for funds that we can look at, but I'm going to go one step further and ask you, what percentage of your portfolio would you say is good to, you know, put into arbitrage funds? Of course, there's no, you know, one size fits all approach, but if you could sort of give us a good average.
No, so this is purely a liquidity management fund, if I may put it like that. So we were just chatting about how much should a person leave the money in bank account or put into. We were just chatting during the break. So so very clearly, if you have some kind of funds and you don't know how long you don't need it for, okay, because sometimes it's an open-ended. You just have the funds, you know that you need it. Say you want to buy a house, for example, and you're looking out for a house. You could get it even in a month. You could get it in a month. You could get it in 6 months or even 1 year. So you don't know the exact time horizon. You can't put in a fixed deposit because you have to define a period. When you're going to place a fixed deposit, they'll ask you whether 6 months, 1 year, whatever. You're not in a position to give that. So it's more of a liquidity management with a minimum of 30 days. If that is the case, then I think the entire money can go into either a liquid fund or an arbitrage fund. So I don't think there's a portfolio allocation per se. It's more to do with how, and most importantly, I mean, as of now, the tax advantage favors arbitrage fund. You don't know, as way the government is going and plugging all the tax arbitrage options available, how long this lasts, God knows.
Maybe time will tell, but of course that was crisp and very helpful explainer on arbitrage funds, and also important to compare all aspects of investing, and that you've done very beautifully. Thank you, Harshvardhan, for joining us and explaining to us all about arbitrage funds, the taxation, the returns, and comparing it with other categories, something like liquid funds as well. But it's time we take your leave, and that's all we have on the show today. Thanks a lot for joining us, and stay tuned for Closing Bell to take you through the last hour of trade.